Question 1. An individual wants to open a brokerage account that allows them to borrow money from the broker-dealer to purchase securities. This type of account is known as A. Cash account. B. Margin account. C. Fiduciary account. D. Discretionary account. Answer: B. Margin account. A margin account allows customers to purchase securities by borrowing funds from their broker-dealer, using the purchased securities as collateral for the loan. This contrasts with a cash account, where securities must be paid for in full. For example, if an investor wants to buy $10,000 worth of stock but only has $5,000, a margin account could enable them to borrow the remaining $5,000 from the firm. Always remember that margin accounts involve leverage and therefore carry higher risks than cash accounts. Question 2. A market where new issues of securities are sold to the public for the first time is called the A. Secondary market. B. Third market. C. Primary market. D. Fourth market. Answer: C. Primary market. The primary market is where new securities are issued and sold to investors for the very first time, typically through an initial public offering, IPO, or a subsequent primary offering. This is the stage where the issuer, such as a company or government, receives the proceeds from the sale of the securities. For instance, when a company like Google first sold its shares to the public, that transaction occurred in the primary market. Think of the primary market as the new issues market. Question 3. Under FINRA rules, a registered representative's personal securities transactions must be reported to their employing broker-dealer, and in some cases, to other firms. This is primarily to prevent A. Excessive trading. B. Insider trading and front-running. C. Account churning. D. Market manipulation. Answer: B. Insider trading and front-running. FINRA rules require registered representatives to report their personal securities transactions to their employing broker-dealer, and sometimes to an outside firm if they have accounts elsewhere, primarily to prevent potential conflicts of interest such as insider trading and front-running. Insider trading involves using non-public information for personal gain, while front-running occurs when a broker trades on their own account before executing large customer orders that are likely to affect the market price. This reporting requirement helps firms monitor and detect any suspicious activity that could harm customers or market integrity. Always remember that transparency in personal trading helps maintain fair and ethical practices. Question: Investment company that issues a fixed number of shares that trade on an exchange or over the counter and are not redeemed by the issuer is known as A. Open-end management company. B. Unit investment trust, UIT. C. Exchange traded fund, ETF. D. Closed-end management company. Answer: D. Closed-end management company. A closed-end management company issues a fixed number of shares only once during an initial public offering, IPO, and these shares then trade in the secondary market like regular stock on an exchange or over the counter. Unlike open-end funds, mutual funds, closed-end funds do not redeem their shares, meaning investors must sell their shares to other investors if they wish to exit their investment. For example, a closed-end fund might trade at a premium or discount to its net asset value, NAV, based on market demand. Keep in mind that their share count is fixed, and they trade like stocks. Question 5. The risk that an issuer may default on its principal or interest payments is known as A. Interest rate risk. B. Liquidity risk. C. Credit risk. D. Market risk. Answer: C. Credit risk. Credit risk, also known as default risk, is the potential for an issuer to fail to make timely interest or principal payments on its debt obligations. This risk is a primary concern for investors in fixed-income securities like bonds, as it directly impacts the likelihood of receiving expected returns and recovering the initial investment. For example, if a company that issued bonds declares bankruptcy, bondholders face significant credit risk. Always assess an issuer's creditworthiness before investing in their debt. Question 6. All of the following are typically considered associated persons of a broker-dealer except A. A partner, officer, or director of the firm. B. A person who works solely as a clerical employee. C. An investment banking representative. D. A registered representative. Answer: B. A person who works solely as a clerical employee. An associated person of a broker-dealer is generally any partner, officer, director, or employee of a member firm, or any person performing similar functions, who is engaged in the investment banking or securities business. However, individuals whose functions are solely clerical or ministerial, meaning they only perform administrative tasks without being involved in securities activities or having direct contact with customers, are typically excluded from this definition. For instance, a receptionist who only answers phones and greets clients would not be considered an associated person. Remember this distinction because associated persons are subject to specific FINRA rules and regulations. Question 7. A customer holding a bond has seen interest rates in the market rise significantly since they purchased the bond. This scenario exposes the customer primarily to A. Liquidity risk. B. Reinvestment risk. C. Legislative risk. D. Interest rate risk. Answer: D. Interest rate risk. Interest rate risk is the risk that changes in prevailing interest rates will negatively impact the value of a bond or other fixed income investment. When interest rates rise, the market value of existing bonds with lower fixed coupon rates typically falls because newly issued bonds offer more attractive yields, making older bonds less desirable. For example, if you own a bond paying 3% interest and new bonds are issued paying 5%, your 3% bond will decrease in value. This is a critical concept for understanding how interest rate fluctuations affect bond prices. Question 8. An investment that represents an undivided interest in a fixed portfolio of municipal or corporate bonds is A. Open-end management company. B. Unit investment trust, UIT. C. Exchange-traded fund, ETF. D. Closed-end management company. Answer: B. Unit investment trust, UIT. A unit investment trust, UIT, is an investment company that offers investors a fixed portfolio of professionally selected securities, typically bonds or other debt instruments, which are held until maturity. Unlike mutual funds, UITs have a fixed number of shares, are not actively managed, and typically self-liquidate on a specified maturity date. For instance, a UIT might hold a portfolio of municipal bonds with different maturities, providing diversified income to investors. Remember that UITs are known for their fixed portfolios and lack of active management. Question 9. Which of the following is typically a characteristic of common stock? A. It has a fixed dividend payment. B. It offers a claim on the company's assets and earnings secondary to preferred stock. C. It usually has a stated maturity date. D. It provides voting rights. Answer: D. It provides voting rights. Common stock represents ownership in a corporation and typically carries voting rights, allowing shareholders to elect the board of directors and vote on corporate policy. While common stock dividends are not fixed and are declared at the discretion of the company's board, and it does not have a maturity date, its key characteristic is the potential for capital appreciation and its shareholder voting power. For example, if a company is proposing a merger, common stockholders would likely have the opportunity to vote on it. Understand that voting rights are a distinguishing feature of common stock. Question 10. All of the following are examples of investment companies except A. Mutual funds. B. Hedge funds. C. Unit investment trusts, UITs. D. Exchange-traded funds, ETFs. Answer: B. Hedge funds. Investment companies are entities that pool money from investors and invest it in securities. Under the Investment Company Act of 1940, common types include mutual funds, open-end management companies, unit investment trusts, UITs, and closed-end management companies, which include ETFs. Hedge funds, on the other hand, are typically private investment pools that are not regulated under the Investment Company Act of 1940 and are generally only available to accredited investors. For example, while both mutual funds and hedge funds manage money, only mutual funds are classified as registered investment companies under federal law. Recognize that hedge funds operate under different regulatory structures. Question 11. An investor who sells a security short expects the price of the security to A. Increase. B. Decrease. C. Remain stable. D. Fluctuate unpredictably. Answer: B. Decrease. Selling a security short is an investment strategy where an investor borrows shares and sells them in the open market, hoping to buy them back later at a lower price to return to the lender. The investor profits if the stock's price declines, allowing them to repurchase the shares more cheaply. For instance, if an investor believes a company's stock, currently trading at $50, is overvalued, they might short sell it, expecting to buy it back at, say, $30. Short selling involves significant risk because potential losses are theoretically unlimited if the stock price rises. Question 12. Which regulatory body is responsible for regulating the municipal securities market? A. The Securities and Exchange Commission, SEC. B. The Municipal Securities Rulemaking Board, MSRB. C. The Financial Industry Regulatory Authority, FINRA. D. The Federal Reserve Board. Answer: B. The Municipal Securities Rulemaking Board, MSRB. The Municipal Securities Rulemaking Board, MSRB, is a self-regulatory organization, SRO, that creates rules for municipal securities firms and their professionals. While the SEC oversees the MSRB, and FINRA enforces MSRB rules for broker-dealers, the MSRB itself is the primary rulemaking body for municipal bonds and municipal advisors. For example, the MSRB sets rules concerning professional qualifications and fair dealing practices in the municipal bond market. Remember that the MSRB is the specialized rulemaker for all things municipal securities. Question 13. Which of the following best describes the role of a transfer agent? A. Executes trades on behalf of clients. B. Provides investment advice to clients. C. Maintains records of stock and bond owners, issues new certificates, and cancels old ones. D. Underwrites new issues of securities for corporations. Answer: C. Maintains records of stock and bond owners, issues new certificates, and cancels old ones. A transfer agent is responsible for maintaining accurate records of a company's shareholders and bondholders, ensuring that ownership changes are correctly recorded. Their duties typically include issuing and canceling stock certificates, resolving problems with lost or stolen certificates, and dispersing dividends and interest payments. For example, if an investor sells shares of a company, the transfer agent updates the ownership records to reflect the new owner. Understand that transfer agents play a crucial role in the accurate administration of securities. Question 14. A fully disclosed broker-dealer is one that A. Executes trades and clears its own transactions. B. Introduces its business to a clearing firm, which processes its trades and maintains custody of client assets. C. Conducts business only with institutional clients. D. Is a member of all major securities exchanges. Answer: B. Introduces its business to a clearing firm, which processes its trades and maintains custody of client assets. A fully disclosed broker-dealer, also known as an introducing broker, is a firm that handles its own customer accounts but contracts with a separate clearing firm to process and settle transactions and maintain custody of client funds and securities. This arrangement means the clearing firm performs back-office functions and is responsible for account statements and confirmations. For instance, a small local brokerage might introduce its trades to a larger firm that specializes in clearing operations. Remember that, fully disclosed refers to the customer information being disclosed to the clearing firm. Question 15. The federal legislation that established the Securities and Exchange Commission, SEC, and primarily regulates the trading of securities in the secondary market is the A. Securities Act of 1933. B. Securities Exchange Act of 1934. C. Investment Company Act of 1940. D. Securities Investor Protection Act of 1970. Answer: B. Securities Exchange Act of 1934. The Securities Exchange Act of 1934 is a landmark piece of federal legislation that created the Securities and Exchange Commission, SEC, and primarily governs the secondary trading of securities. This act addresses aspects such as the regulation of exchanges, broker-dealers, and markets, as well as provisions against market manipulation and insider trading. For example, it established the framework for reporting requirements for publicly traded companies. Keep in mind that the exchange in the title is a clue, linking it to the secondary market. Question 16. All of the following are typically characteristics of preferred stock except A. No voting rights. B. Priority claim on assets in liquidation over common stock. C. Fixed dividend payment. D. Participation in extraordinary earnings growth. Answer: D. Participation in extraordinary earnings growth. Preferred stock typically pays a fixed dividend and has priority over common stock in receiving dividends and in claims on assets during liquidation. However, preferred stockholders generally do not have voting rights and do not participate in the company's extraordinary earnings growth, as their dividend is usually capped at a fixed rate. For instance, if a company has a highly profitable year, common stockholders may see a significant increase in their dividend or stock price appreciation, while preferred stockholders receive their fixed dividend. Remember that preferred stock offers stability but usually limits growth potential. Question 17. An investor seeks an investment that offers professional management, diversification, and liquidity, with the ability to redeem shares daily at net asset value. This describes A. Closed-end fund. B. Exchange-traded fund, ETF. C. Mutual fund. D. Unit investment trust, UIT. Answer: C. Mutual fund. A mutual fund, officially known as an open-end management company, is a popular investment product that provides professional management, diversification by pooling assets, and liquidity. Investors buy and redeem shares directly from the fund company at the end-of-day net asset value, NAV, which ensures liquidity and the ability to exit the investment whenever desired. For example, a growth mutual fund invests in a diversified portfolio of stocks and allows investors to add or withdraw money daily. Always remember that daily redemption at NAV is a key feature of mutual funds. Question 18. Under the Uniform Practice Code, UPC, regular way settlement for corporate equities and bonds is typically A. T+1, trade date plus 1 business day. B. T+2, trade date plus 2 business days. C. T+3, trade date plus 3 business days. D. T+5, trade date plus 5 business days. Answer: B. T+2, trade date plus 2 business days. Regular way settlement for most corporate securities, including equities and bonds, occurs on T+2, meaning the transaction must be settled by the second business day following the trade date. This is the standard period during which buyers must deliver funds and sellers must deliver securities. For instance, if you buy a stock on Monday, the transaction would typically settle on Wednesday. Understand that settlement date is when ownership legally transfers and payment is due. Question 19. An individual who provides investment advice for a fee is most likely required to register as A. Broker-dealer. B. Issuer. C. Investment advisor. D. transfer agent. Answer, C, investment advisor. An investment advisor is an individual or firm that provides advice about securities for compensation. Registration as an investment advisor is typically required under the Investment Advisors Act of 1940 or state securities laws, depending on the amount of assets under management and the nature of their business. For example, a financial planner who charges clients a fee for creating and managing their investment portfolios would be required to register as an investment advisor. Recognize that giving advice for compensation is the key trigger for investment advisor registration. Question 20. The primary purpose of the Securities Investor Protection Corporation, SIPC, is to A. Regulate broker-dealers and exchanges. B. Protect customer accounts from broker-dealer failure. C. Ensure bank deposits. D. Provide investment advice to retail customers. Answer, B. Protect customer accounts from broker-dealer failure. The Securities Investor Protection Corporation, SIPC, is a non-profit, member-funded corporation that protects customers of its member broker-dealers up to $500,000, including $250,000 for cash, in the event of a broker-dealer's insolvency or bankruptcy. SIPC does not protect against market losses or poor investment decisions, but rather against the failure of the brokerage firm itself. For instance, if your broker-dealer goes out of business, SIPC ensures your securities and cash are returned within specified limits. Remember that SIPC protects against broker-dealer failure, not investment losses. Question 21. Which of the following orders must be executed immediately and completely, or else cancelled? A. Limit order. B. Stop order. C. Market order. D. Fill or kill (FOK) order. Answer, D. Fill or kill (FOK) order. A fill or kill (FOK) order is a type of order instruction that requires the entire order to be executed immediately and completely, or if it cannot be filled in its entirety at once, the entire order is cancelled. There are no partial executions or waiting periods allowed for an FOK order. For example, if an investor places an FOK order to buy 1,000 shares but only 900 are immediately available, the entire 1,000 share order would be cancelled. Understand that FOK orders are very strict about immediate and complete execution. Question 22. An investor interested in receiving regular, predictable income from an equity security would most likely prefer A. Common stock of a growth company. B. Preferred stock. C. Warrants. D. Options. Answer, B. Preferred stock. Preferred stock is designed to provide investors with regular, predictable income through fixed dividend payments, which are typically paid before common stock dividends. Unlike common stock, preferred stock usually does not offer significant capital appreciation potential but prioritizes dividend payments. For example, a callable preferred stock might offer a 5% fixed dividend, appealing to income-focused investors. Remember that preferred often implies a preference in dividend payments and a more stable income stream. Question 23. An individual who opens a retirement account and directly manages the investments within that account, such as buying and selling stocks and bonds, is typically participating in A. Defined benefit plan. B. Non-qualified deferred compensation plan. C. Self-directed qualified retirement plan. D. Section 403B plan. Answer, C. Self-directed qualified retirement plan. A self-directed qualified retirement plan, such as a 401k or IRA where the participant chooses the investments, allows the individual to manage the investments within their retirement account directly. These plans offer tax-advantaged savings, and the term qualified means they meet specific IRS requirements to receive tax benefits. For example, an individual might open a self-directed IRA and choose to invest in a mix of mutual funds and individual stocks. Understanding the self-directed nature is key for these common retirement vehicles. Question 24. A prospectus must be delivered to an investor for which of the following securities? A. U.S. Treasury bonds. B. Municipal general obligation bonds. C. New issue corporate equity securities. D. Commercial paper. Answer: C. New issue corporate equity securities. Under the Securities Act of 1933, a prospectus is a legal document that provides detailed information about a new issue of securities and the issuer, and it must be delivered to prospective investors prior to or concurrently with the sale of the security. This requirement primarily applies to new issues of non-exempt securities, such as corporate equity securities. Exempt securities, like U.S. Treasury bonds, municipal bonds, and commercial paper, are typically not required to be accompanied by a prospectus. Remember that the prospectus ensures full and fair disclosure for new, non-exempt offerings. Question 25. The economic theory that suggests that government spending and taxation policies can influence economic activity is known as A. Monetarist theory. B. Supply-side economics. C. Keynesian theory. D. Classical economics. Answer: C. Keynesian theory. Keynesian economic theory posits that government intervention, through fiscal policies like taxation and spending, can significantly influence aggregate demand and stabilize the economy, particularly during recessions. This approach suggests that governments should increase spending and reduce taxes during downturns to stimulate demand. For example, government stimulus packages aimed at boosting consumer spending are an application of Keynesian principles. Understand that Keynesian economics supports active government involvement to manage economic cycles.